To some extent, this paper is a history of what's going on in Spain, because you see, it has my name, it has my friend Juan Carlos Conessa's name, and it used to say Universitat Autónoma de Barcelona, but now it doesn't. You see, so he's been involved in moving and so forth as Spain falls apart. I was there, I spent most of the year there, 2010 and 11 on leave, and Juan Carlos said to me, Tim, we got to do something to think about the crisis that was starting then. This is before it actually hit Spain. And he said, you wrote these papers with Hal Cole about the Mexican crisis in 1994-95, and it has to be relevant somehow to what's going on now. And that was puzzling to us, but here's what came out of it. So here's a kind of well-known picture, starting with the implementation of the European Economic Monetary Union, called the EMU, in 2000. It was planned in 1992, but it was finally fully implemented in 1999-2000. We saw an amazing convergence of yields on government bonds. The European central banks prohibited from engaging in open market operations. So in response to this crisis, they do something that looks remarkably like it. But as collateral on loans, it's part of their constitution that they have to accept bonds indiscriminately from different member states equally. So we saw this remarkable convergence of rates. And then starting in 2008, they started moving apart. And I had to chop off the top, because otherwise you just see Greece exploding in 2011 and 12. Okay? And you notice the huge spreads. So if I interpret those spreads, we don't really have a theory of haircuts here. So, but I just want you to think in more general terms. Spreads are going to somehow reflect a probability that investors associate with a crisis. And the basic idea of the Kehoe papers was that if debt levels are low enough, or the need to roll over debt is small enough, there can't be a crisis. And since there can't be a crisis, investors in equilibrium, it's going to be very much an equilibrium model, don't fear a crisis and nothing happens. Of course, high enough level of debt, the question is how you could ever get there, but somehow Greece managed to get there. That's an interesting story. Then you're just going to default. You don't even want to pay the debt service. For in-between levels of the debt, the optimal policy is to run down the debt, to try to run surpluses, because you're subject to these self-fulfilling runs, and you have to pay higher debt service. So it just doesn't make sense. The optimal policy is to run down the debt. But when we look at, and I'm back to calling these the countries in trouble in Europe, I'm back to calling them the pigs. They're running up the debt. This isn't percentage of GDP. This is percentage of a fixed year GDP just to adjust. Of course, as a percentage of GDP, it's going up much more. So why were Hal and I wrong? It's because something was going on in these countries. Greece, of course, is an extreme case. That wasn't true of Mexico in 1993-94. These countries are in very severe recessions that are still ongoing. In fact, Greece, this will be good, because if Prescott and I have to come out with another Great Depressions book, Europe is helping us out right now. People interested in in international comparisons, there's a very famous paper by Aguiar and Gopinath called "The Cycle is the Trend," talking about how different developing countries are from developed countries. And I've always said all that's doing is picking up the 1980s in Latin America. If you drop that out, if you just do their analysis up till 1980, there's no difference. And now this will make the point in a different way. When this crisis plays out, we include the European countries in, it's going to look like the cycle is the trend for developed countries as well. Although we might not call countries like Greece developed anymore if they get poor enough. It'll be like the Argentina of the 21st century. Okay, enough jokes. I got to keep pushing on. And of course, government revenues collapse too. In some of these countries, it collapsed more than GDP because they had progressive tax systems. In 1995 in Mexico, the first 3 quarters, they took a big hit. But that's because, and this is what we were talking about, everyone expected Mexico to default. And so the financial system just tanked. But then by the end of 1995, they started this period of spectacular growth that lasted until 2000. Okay, so what am I going to do? I'm going to explain, extend Kehoe to stochastic output, and then the intuition is just really simple here. In any kind of incomplete markets model with consumption smoothing motive, most of these are for individuals, but it could be countries, you're going to have an incentive every time you take a bad hit to borrow, to smooth. You're approaching maybe some kind of limit, so your borrowing goes down every time, but you're always borrowing, hoping next year things will be better. Next year things will be better. And then so you run up the debt. And we're going to call that, this is a term, I guess, from the finance literature, gambling for redemption. And then I'm going to think at the end, so this is why the discussion of the Clinton bailout of Mexico in January '95 is relevant. Because the financial crisis in Mexico pretty much ended when Clinton came up with this bailout package of $50 billion. It ended. Whereas the crisis in Europe, and that's why, although I'm embarrassed how long it is to get a fixed, nice version of this paper done, somehow there's no rush. I mean, the crisis isn't going to end soon. So we're going to think about troika policies. Could the troika bail out the troubled countries in the EU the way that Clinton bailed out Mexico? And I'm going to say maybe not. This is more recent stuff that Juan Carlos and I are doing. See, what did Clinton do? He followed the dictum. What should a central bank do? Bagehot's dictum. Lend freely, penalty interest rates, good collateral. That's what Clinton did to Mexico. He offered them more money than they needed, high interest rates, and he said, if you don't make a payment, the Federal Reserve Bank of New York is taking over all your oil revenues and just passing what's left on to you. Okay, so 2 forces in the opposite direction. You want to run down the debt to get out of the crisis zone, not have the risk of a default and the associated penalties and the high interest rates, but you want a consumption smooth. The model I'm going to show you at the end, those 2 forces are simple, and you can put them into analytic models. When you put the whole thing together, though, it's numeric, and you've got to put it on the computer, and I'll just show you some results. It all depends on parameter values and troika policies, and sometimes, and for the same set of parameters, depending on the debt, sometimes you say, oh, we're close enough to the safe zone that we should run down, Or if your debt's really high, you say, oh my God, it would just be way too painful to cut spending now and run down our debt. The hell with it. Let's just run up the debt. Part of this was inspired by the Spanish newspapers. Kept talking about what the heck is George Papandreou doing back when he was Prime Minister of Greece. Of course, he's a guy from St. Paul, Minnesota, so I wanted to be, have a favorable take on him. And I said, our model says he was doing the best thing he could. Given how high the debt was, he'd go and tell Mrs. Merkel, don't worry, next year, we got this under control. And then they'd keep going back and say, oh, it was just too tough. In fact, we ran up the debt. So, basic results. If you're in a region of debt where you're susceptible to a self-fulfilling run, you run down the debt because interest rates are high and costs of default are high. But you run up the debt if the EU, ECB policies make interest rates low, as they very actively did, or if costs of default are perceived to be low, or if this recession is severe and you think something good is around the corner. Now, Juan Carlos and I have extended this, not just the probability of a recovery, but a probability of a bailout. So the general model has government, international bankers who are going to be very simple. We discovered we could make people often say they like Jerry was telling me before how much he loved the Kehoe model, but that's complicated because the consumers do all these complicated private investment decisions that interact with the possibility of crises. We've just cut that out. So this now is a much easier model, one you could even teach very easily in class. Debt, whether the economy is in recession or not, whether the government has defaulted in the past or not, and some news that is otherwise irrelevant if you're not in the crisis zone, but then could panic the investors. The kind of real side of this economy is so simple, it's incredible. We could put this all in growth rates, but I'm just going to kind of detrend that out, and this is in levels. The level of GDP is, say, 100. Y bar. How can it differ? Well, there's this stochastic output, and capital A might be a number like 0.9. So that if this little a goes to 0, it turns this thing on, and then this becomes 90 instead of 100. Then there's also a default penalty, like 0.95. Okay? I'm going to also talk very briefly about a model without that recession element in it. And that's just called Kehoe without private investment. And the only thing you can have is a drop in GDP because of default. And I'm going to talk about a model in which somehow there's no possibility of self-fulfilling crises, but GDP can go up or down. Just to see those are the two I can characterize analytically what happens, and then you put it together and you're going to get some mixture, but a very nonlinear kind of mixture. Now, in particular, I don't know, and if I was really well informed, I'd tell you some kind of story about what the heck these governments were doing up until 2008 that made them so vulnerable to this. But I'm not. I'm just going to take the debt as given, and then in 2008, the boom ends. And then they're praying for things to get better. To keep things simple, I'm going to have the default penalty last forever, and the other default penalty is you're excluded from markets. Hal and I, in one of our papers, have a discussion of the extension of that. The same general results go through, but the model becomes a lot more complicated. So we're just going to leave that out. So here's just a kind of picture of what could happen. You're cruising along. Things are great. This, I know, this is 2008. Then we get a drop in GDP. Later on, we could have a default. So far, only Greece has actually defaulted. Then, at some point, you might start recovering, but if you defaulted, you're permanently penalized. That's not essential, but to keep the thing simple, it is. Sunspot is just this thing that's and I want to stress the probability of a sunspot being negative is kind of arbitrary. It's this parameter pi. How bad does the bad news have to be before you panic? And in fact, I'll briefly mention at the end, we have a model with that probability, the crucial level of the bad news, varies itself stochastically. And it's kind of trivial, but it can give us this picture where the spreads just jump around. No, just randomly. It's going to be a rational expectations equilibrium that the whole sunspot cannot even turn on until you pass a certain critical point. And at that, I'm going to show you that calculation. So I'm not going to, especially when there's beer and dinner waiting, I'm not going to go through all the gory details of this, but here's a reduced form version of the model, and I'll talk about the timing just a bit so you see where this is coming from. Here's the dynamic programming problem that the government solves. It is a benevolent government. In the literature, in recent literature, people often like to make the government have different preferences, and that might be what we might call realistic than private consumers or the foreign lenders. But we're gonna do this with everybody having the same discount factor. If you make the government more impatient, it's really easy to get the government to run up the debt. And that's a standard trick. That's definitely not what's going on here, though. U is concave. So everybody wants the government to smooth. The consumers here are very passive. This is not like the Kehoe models, because all the consumers do is take what's left over of GDP after they pay taxes. We're going to have the government fiscal policy, the tax policy, just be fixed. Here's the essential thing in the model is the government's budget constraint. Government has spending, which it determines every period, and paying back the debt or not. So Z is the default decision. That's the outflow, and the inflow are tax revenues and what it's able to get by selling bonds. And the bonds depend on, in particular, they depend on the old state, the old level of debt, and the stochastic shock. There's two stochastic shocks, whether the private economy goes up or down, and whether the news is bad or not, and then how much debt they're offering. The bankers here are very uninteresting. And of course, there's lots of papers like my colleague Christina Ariano and Bai now are working on something on contagion, having the bankers being risk averse, having there be multiple countries, interaction, none of that. The basic idea is the price that you can get for a bond at the auction is just going to be the risk-free price, which is going to be beta, times the probability that you associate with being repaid. Here's the timing. It's within a period, the government has to offer the bonds before it pays back the old bonds. And this was based on this kind of, you need some timing like this implicitly to get what we call rollover crises now. You offer the bonds, but you can't promise to pay back the old bonds. If there's bad news, in fact, the investors know that you're not going to repay the old bonds, so they don't buy the new bonds. So you needed this certain kind of dynamic consistency problem in there. The government acts at 2 points: when it offers the new bonds for sale and when it pays back the old ones. If the news is bad, then the bankers say to themselves, I am not going to buy the new debt because I know that tomorrow, in fact, this was all motivated by the way they did peso bonos. The peso bono auctions were on Tuesdays, and they're paying back the old peso, and I'm not making this up, the old peso bonos were paid off on Thursdays. And if you went back and looked at the Wall Street Journal, the whole month of January, they described what happened at each and every auction, and then each and every Thursday whether they were getting paid back or not. And this happened on January 31st. They said, next week they're not going to be able to pay back. In this model, since you're going to be hit with the default penalty, you might as well pay back nothing. And of course you can define a recursive equilibrium. I always make my students do this so I can just check they learned what they should in their courses, but you know, I did it right, I think. Here are the cutoff levels. The cutoff levels are probably best seen in a picture. Here's the schedule for bond prices. Remember, the economy is either in normal times or recession. So we're going to have two different schedules. The schedule that's the steps going here, down, down again, down again, down again, that's recession. The dotted part is normal times. If that's low enough, you're going to repay no matter what. So nobody panics no matter what the news is. Then we get to another level where you know that they're going to pay back next period as long as the economy recovers no matter what. Or if the economy is still in recession, as long as the news is good. Then, at least for some parameter values, for recessions that are not too severe, sometimes these can reverse. Then you go to a region with lower bond prices because you're going to repay back next period whether or not the economy recovers, only if the news is good. And then finally, to a situation where Greece could have been in the summer of 2011, where people said, woof, they're only going to repay next period if a miracle occurs. And you get a very low price for bonds. Okay? So if you kind of get that idea, then that's the essential thing in the model. Okay, so here are these two special cases. And it's kind of fun because the value function is discontinuous because of the lack of commitment. It has kinks, but you can solve it. And Juan Carlos is great at computer programming. The two special cases, and I'll just, rather than going through details, let me just show you one calculation to give you an idea how this model's really simple. In the absence of uncertainty, wherever you are is a steady state. And that's how we've rigged the kind of thing. So you get really simple formulas when you're in the safe zone, as long as you don't have the recession going on or not. And for example, the upper limit of the safe zone, the lower limit of the crisis zone is just determined by the condition that if the bankers, if the international investors don't lend to you, you pay back anyway. So let me just talk this through, and then you realize all the calculations are like this, although sometimes you need to put in dynamic programming policy functions here to get what's going to happen with debt afterwards. So what's this? This just says, here's a level of debt that if you repay it all at once, later I'll talk about debt maturity, but if you repay the debt all at once, you get a level of, discounted level of lifetime utility for the consumers and for the benevolent government that's greater than or equal to what happens from defaulting. Defaulting is always simple. You get hit with the Z penalties and you're stuck there forever. So, but it turns out that this model is actually analytic, and sometimes nowadays I make my students actually work this through. The first order conditions say, when you're in the crisis zone, you have to cut your government expenditure. That's painful. But while you're hit with that constraint, the smoothing says, keep it constant, the government spending, until you get to the safe zone, and then it can jump up. Given that, you can get analytical formulas for everything. And what it ends up meaning is you can actually compute, starting at any point B0 in the crisis zone, you can compute what the value of the expected value of running down the debt in T periods. Then what do? You maximize over T. And you just get nice, easy formulas. Then it's chopped off. That you can run B out to infinity. But the whole thing is chopped off when you say, oh, I'd just rather default than do that. So here's the kind of pictures you get. Up top you default, down here steady state, in between you run down. The higher you are, the more periods you take to do it. Why do you take more than one period? Because it's too painful to cut that much. And I'll show you an actual, Fernando's trying to see it. Here's an actual picture. You're close enough, you run down in one period, this 2 periods, 3 periods, so forth. The picture in principle runs all the way up, but at some point you just say, screw it, and you default. So that's that model. Then, the other model is like Iagari's worker, who always is, he's unemployed, but stochastically he can get reemployed. But poor guy, this is like Europe, where the recession's just going on and on and on. So he's unlucky. Here's our uncertainty tree, because, and you already spotted this, Fernando, to keep things easy, if you recover, we're going to keep you out. So this is why we don't get the curse of dimensionality. What's happening here is that your expected income is higher in the future than today. Because right now you're out of work, and you just desperately want to smooth your consumption into the future. You would love it if you could get and so what's the market incompleteness that makes everything bad here? You can't get a contingent thing saying, I pay you back if I have a job next period. And so what happens? Here's where the guy runs up his debt until he hits the limit. And then he doesn't go over it because it's painful. But if the costs of default are low enough, they can actually, and the probability of recovery is high enough, he can actually say, hey, I'm going to borrow one last time, and I'm going to default if I don't recover, and I'm going to pay back if I do. So here is, I'm going to show you a numerical example here, although we're changing this now because beta here is so high, we chose that to match the German interest rate of about 2%. I don't fully understand. Of course, Prescott and Mirror didn't. The very low interest rates on government debt. I'm not sure that's a good reflection of beta. We get more interesting results with 0.96, but I haven't gotten it in the paper. Poisson probability 0.2 of recovery. So when I was in Spain in 2011, I spent a year and I was going back and forth between Barcelona and a certain amount of time in Madrid. And I tried to get the taxi drivers to talk to me about the soccer. Although Madrid was not that much fun because I'm a Barcelona supporter and I thought they'd argue with me. But all the taxi drivers, if you've never been in Madrid, are all supporters of the Atlético de Madrid. And they tell me, oh, I hate Madrid more than you do, the football team. So that was not interesting. And then they said, what do you do here? One even said to me, you're a German, right? I said, oh my God, I'm an American. He said, no insult. I've just never met an American who speaks good Spanish, so I thought you must have been German. I said, what do you do? I said, I'm an economist. He said, how long is this crisis going to last? And I thought I had to be, meaning the word, you guys who speak Spanish know Spanish is imprecise on that. Crisis means recession in that sense. And I thought I'd be nice. I said, maybe it'll be over next year. And I swear the guy said to me, what the hell kind of economists are you? That's the stupidest answer I've ever heard. We're in trouble here. Okay, so then I discovered I could tell him 5 years and get away with it. Sometimes you could get away with 10 years too, but 5 years I could get away with. So what's the waiting time on a Poisson process with recovery probability equal 0.2? 5. Although I told that to my friend Andrea Mascole, who said he was going to use it in a speech, but he said, you know, Tim, the problem you're going to run into, if you're back here next year and you happen to run into the same taxi driver, he's going to say to you, oh, you're that crazy economist, and you said we had to wait 5 years. 1 year's gone by, it's 4 years now, right? And then you have to explain, no, because you missed out on that small little probability, it reset, it's always 5 years. All right. Here is an essential thing. Here's an essential thing in the model. What does the government perceive the essential level of government spending to be? This puts extra curvature into the utility that makes cuts really painful. First 1 year bonds, and then I'm going to do multi-year bonds. So this is just a really simple cold Kehoe. Don't take the numbers seriously because 1 year bonds are not that realistic. And here's a kind of picture that's really typical, although once again the numbers are wacky. And the gambling for redemption isn't quite drastic enough because of that really high discount factor, low discount rate, 0.98. That's one of the reasons we're going to 0.96. We get much higher above the 45-degree line then. A crisis hits, the lines shift down. A level of debt that might have been safe before is not safe anymore. At the upper end, and this is like in some of Christina Ariano's model, if you have that level of debt, you're just going to default if you enter a recession. If you're low enough, you still run down. If you're high enough, you say, screw it. Maturity of debt. See, in the Mexico crisis, this didn't come up. And this is worth stressing. The maturity of debt in 1994, by the end of 1994 in Mexico, was 2/3 of a year. You know, was 8 months. Here it's like 6 years. So we can use this Hachondo Martinez, Chatterjee, Eigengor trick of having, they call it memory-less debt, but it's just every period you have to pay off a fraction delta of your debt. Of course, if you wanted to really take seriously the refinancing needs, it's much more complicated because it depends on lots of stuff. But I'm just going to reduce it all to delta. Okay, and delta might be 1/6. That's what I want you to be thinking. And then, of course, you get a more complicated, but it's still a nice recursive set of formulas for debt, especially because the investor can, two things. The investor's risk neutral, and he can predict what the government's going to do as a function of the stochastic shocks. So here's what I already showed you. That's with 1-year debt. 2-year debt, you know, you get to borrow a lot more. And the safe zone starts moving up. Till finally, with 6-year debt, this is not a calibrated model. But I like the numbers. You're completely safe if your debt's less than 60% of GDP. And you're going to be in trouble if you're over 120. That's kind of like, you know, the Maastricht Accords. Remember the pricing of bonds, the price you get for bonds here is much higher than here. So that's why this point, getting down to the level where next year, if you recover, you'd be safe, that's a kind of, this shows like the full non-linearity of everything. Here, you run down to the true safe point, but here you run up, and this kind of attracts things, and then you're just gambling, you're praying for redemption, and at the top, you're just saying, screw it. I can't run down. I see Veronica nodding because she knows that's what they do in Italy. But I mean, see what's going on? It's kind of interesting. Okay, I'm going to finish up. But suppose, for example, that government spending increases the probability of a recovery. Something, you know, Krugman might say. Then you want to gamble. But here, you know, Krugman wrote a paper during the Asian crisis, and he said, governments are often Panglossian. They try to imagine they're in the best of all possible worlds, and that's why they borrow so much. But see, he wasn't thinking general equilibrium, like who sets the prices. In this model, if you as a government associate a higher probability with recovery than do the lenders, you borrow less. Why is that? It's because they're charging you too high of an interest rate. It's just the opposite of what Krugman thought. So here's another way to think of it, though. So here's another good story for George Papandreou. If the government has private information that the situation is worse than it seems, that's if the government's pessimistic, not overly optimistic, then it should borrow up to the hilt. Wow, Mrs. Merkel is still willing to give me money. I can help my country out as long as she keeps giving it to me. If he's going to, no, that's true. That's true. That's true. Like I said, we can make the risk premium do whatever we want, although then everything just becomes black boxy computer-like. But we run this thing out with Premier jumping up and down, default. Taxi driver said to me in Barcelona once, he said, do you think we can get through the summer if the spreads over German bonds stay over 500 basis points? And I thought, wow, when taxi drivers talk to you like that, that means something's going on in this country. But Juan Carlos said, yeah, two things happened. That's a guy who otherwise would have been talking about football, but now things are so bad he reads the newspapers. Or quite likely, he's an unemployed financial sector guy. That's why he has all the vocabulary. Okay, so we have a plausible explanation for the observed pattern of behavior of pigs. And we've rigged the numbers a bit. It's not calibration, but they're reasonable numbers, and they give reasonable kind of predictions. Now, the question, of course, is why Greece and not Belgium? I don't know. But why the Eurozone and not the United States? Now that's going to touch off the discussion, and Veronica already discussed it. And I don't know, but maybe it's because we can inflate. And I know this is the kind of thing that, Manuel's interested in. Let me just mention bailouts and costly reforms. I'm not going to say anything about costly reforms right now, although that's something that Juan Carlos and I are working on. I'm going to say something about, because we have a more recent paper, is it too late to bail out the troubled countries in the Eurozone? And the short answer is yes. For most of it, it's too late. Why? Because suppose that the Troika could step in and do something like that Walter Bagehot or Bill Clinton said to Mexico. We're going to charge you high interest rates, and to assure you want to repay, we're going to put collateral on. The German press or the Finnish press would have jokes about, yeah, they just have to give us some of their islands, the Greeks, you know. And then the Greek press would have jokes about the Nazis coming and so forth. I mean, things are pretty ugly for a while in Europe on this collateral issue. But here's what we find. If the penalty interest rate isn't high enough, then the government's going to keep running up the debt. And if it's too high, they just say, no, I'm not going to take that deal. I'd rather default and drop out of the EMU right now. Here's what could happen. The Europeans could realize, especially in countries like Portugal, Ireland's a different case. That was the government deciding to bail out the banks. But in countries like, Italy, Spain, Greece, they could just say, hey, we're not as rich as we thought we were. We're really a poor country. We're not going to return to where we thought we were back in 2005. And so let's not riot if they cut government spending. Let's vote for politicians who are going to raise taxes and tighten our belts. That'd end the crisis. Remember, 60% in the other model, 60% of debt was safe. Now, if debt is really short term, it's only like 15% is safe. This isn't the model calibrated to Mexico. Mexico's debt to GDP ratio in 1994 was about 40%. Part of, and I hate to sound like I'm agreeing with Krugman on all these things, but part of the reason Mexico recovered so fast is that it had this big devaluation, and then it was able to have booming exports. And so the sudden stop that occurred in Mexico occurred in like 2 quarters. Whereas Spain has gone from, in 2007, a 7% trade deficit to GDP up to balanced trade now, and it took 7 years. That's not a sudden stop. So, yeah, there's all kinds of differences. Models are simple, the world's complicated. But as Tom says, it takes a model to beat a model. So let's see if you can beat me. Thank you.
So I thought Tim's paper, there was a very interesting idea in there, and it's a very complicated model. So this discussion, it's gonna be like the Cliff's Notes for Knesset and Kehoe. All right, so to me the main idea in this paper is that to think about the reason, two fundamentally different reasons why countries may get into trouble and, and potentially be forced to default. And the analogy is thinking about bank runs. So in the context of financial crisis, we distinguish between banks that are insolvent and banks that are just illiquid. So illiquidity, to me, it means a short-run, it's a short-run issue, a short-run inability to repay because some assets can't be converted quickly into cash. Insolvency is a long-run inability to pay because you just maybe you invested in projects that didn't do well, but you just you don't have you don't have the assets to repay. And we know from Diamond and Dybvig and other models of banking that the very nature of banking, which banks borrow short and lend long, any bank is open to a run. So we could all run down to JP Morgan Chase and empty out their cash vaults, and that's not because they're a bad bank or they're insolvent. Okay, and we know too that one function we think of a central bank is to extend loans to banks in the event of liquidity crisis. So it's not to bail out insolvent banks, but to prevent illiquidity from spilling over to real things. Okay, so this paper looked to me, the main idea was to look at sovereign debt in a similar way. So the asset that backs sovereign debt is future tax revenue. And as with bank runs, we want to distinguish between illiquidity, which is a short-run inability to repay, because for some reason the government's issued short maturity debt, it has to be rolled over, and financial markets may just decide we're not going to extend credit anymore. And the analog of insolvency is it could be an inability or at least an unwillingness to raise the necessary tax revenue to pay off the debt. Now, since courts have limited ability to force repayment, it's really the willingness of the borrower to repay. So it's not just ability, but it's willingness. Okay, so the main questions, and to me in this, are what does borrowing look like, and what circumstances would lead the borrower to run a risk of default and to actually default? And would it be useful for an outside agency to play the role of a central bank and lend, as prescribed by the Badgett rule? Okay, so as I said, what I'm going to do is just sort of briefly sketch the model. It's going to be a very stripped down version of the model. Look at borrowing in an environment with no crises, and then look at borrowing, when their crises are possible, and then, suggest some further questions that I think this paper raises. Okay, so the motive for borrowing here is just, consumption smoothing. So I think, all the story about tax and government spending, and you could just think about just a consumer whose income is exogenous. And we're going to think about a regime where income starts out low, and every period that it has remained low, it has some probability of recovering, and once it recovers, it stays there. So the recession is going to end at some random date. Now, okay, so this consumer wants to borrow to smooth consumption. He knows his income is going to recover someday. The only question is when. So, and he can borrow. And what's the incentive to repay? Well, okay, so there are two. One is that if you default, you take this penalty, your whatever your income is, low or high, it's multiplied by Z out front, where Tim wants to think of Z as 0.95. Okay, so that's the penalty for default. That's one penalty for default, and the other is you're excluded from debt markets forever after. So it's a one-time game. Okay, so now what's a crisis? I would think of a crisis as like a sudden stop. It's a one-period event where lenders just say, we're not going to lend anymore. So it leads to illiquidity in the exact way that a bank run does. So for my discussion, I'm going to think just about one period debt. If you had multi-period debt, you'd have to make Tim's adjustment with the deltas. Okay, so a crisis occurs with some probability in any period, and that probability doesn't depend on anything. So it's just there. So if there's no crisis, the government can decide how much debt to issue, and an important feature is that the bond price is always actuarially fair. So the lenders know what the probability of default is. They know this borrower is rational. Default is a calculated decision, and the lender knows the probability of default. Okay, so at the beginning of the period, the government knows the face value of the debt that it issued last period. Output's either low or high. So while it's still in recession, it's low. And it knows whether there's a crisis or not this period, and whether it's defaulted any time in the past. Now, if it's ever defaulted, the game's over. There's nothing more. It can't borrow. All it can do is consume. This consumer just consumes his income. Okay, so we're going to start in the recession. When the recession ends, it's over forever, and P's that probability. The crisis is a one-period stop in lending. The probability of that is pi, and z is some number less than 1. Okay, so the government sees current output and sees if there's a crisis. So if there's a crisis, it can't borrow, and it has to choose whether to default or repay. And if there's no crisis, it still has to choose whether to default or repay, and also how much new debt to issue. So first I want to think about an environment without crises. So if no crises are possible, the only uncertainty is when is recovery going to occur? So then 2 debt thresholds are important. So let B bar H and B bar L denote the maximum debt this borrower would be willing to roll over forever rather than default. Okay, so and it's a higher level if the recession is ended. Okay, so after the recession ends, this borrower is never going to borrow, and it's just the only motive to borrow is consumption smoothing. So after the recession is over, there's no more borrowing, and it'll just roll over the debt forever. It doesn't repay; it just rolls over. It could borrow more, but there's no incentive since the only incentive is consumption smoothing. Okay, so now we have 2 types of equilibria that depend on parameter values. So in type A, there's never default. So the borrower runs up his debt asymptotically towards this limit B bar L as long as the recession continues, but those loans are always repaid for sure. So the bond price is beta, and after the recession ends, the debt is rolled over. So the other possibility is default could occur. So then it's just what the borrower does is, as long as the recession continues, the borrower runs up debt along some deterministic path until some date I'm going to call cap t. Now in cap t, the debt is getting close to that limit b bar. And at date cap t plus 1, the government, if the recession ends, they're going to repay. If it continues, they're going to default. So in period t, the debt price is lower. It's only q times p because the probability of repayment is p. So, okay, so a low p reduces the benefit from borrowing because the debt price is low. And low z increases the cost of borrowing because you pay that forever, even after you come out of the recession. So low values for P and Z, this is just conjecture, are going to give type A equilibria. Higher values for P and Z are going to give type B equilibria. So here are some time paths. So up here in the world where there's never default, the penalties are high enough. So here I have, this is just time. So as long as the recession continues, this lender is, running up his debt. So here I have, the red line is a recession that ends after 1 year. The blue line is a recession that ends after 2 years. And then the debt's just rolled over. And then the green line is a recession that just keeps continuing. But this guy never lets his debt exceed this threshold. So if the recession goes on too long, the additional borrowing is basically non-existent. The other possibility is, that if the recession goes on long enough, the borrower is willing to, punch through this ceiling and risk. If the recession goes on this one more period, he defaults. Now the lenders anticipate that, and the debt is all priced accordingly. So, and this is, I guess, what Tim was calling gambling for redemption. And here, with 1 period of debt, you get to do that for just 1 period. So, okay. Now suppose we toss in a positive probability of a crisis. So, crisis means just for 1 period, lending dries up. And I want to suppose now that after the recovery occurs, there's no more probability of a crisis. So now there's going to be another threshold, a lower threshold, B bar C, which is going to trigger default in case of a crisis. So as long as output remains low, we're still in the recession. If a crisis occurs, the borrower just bites the bullet and repays the whole thing if the debt's small enough. But if the debt's larger, he's going to default. If no crisis occurs, then if debt is below this higher level, B bar L, he'll roll it over. And if it's above B bar L, he defaults. So now it's similar to the previous case, except that if there are crises when the recession hasn't gone on too long and the debt's still pretty low, the lender's willing to just pay it all off, bring the debt back to 0, and start over. All right, so now we still have this threshold BL that, if he gets above here and the recession is still going, he's going to default. But here I have, okay, the recession goes on for 2 years. There's a crisis. But here the debt level is still low enough. It's below this trigger, this threshold. So the lender just pays it off, bites the bullet, pays it off. The recession is still going on. So now he starts borrowing again, runs up the debt. Another crisis right away, and then pays it off. All right, now he's running up the debt again. No crisis, no crisis, no crisis. If he gets up here and another crisis occurs, now the debt's too high, and he said, I'm going to default. Or if there was no crisis and he kept going, if he ever gets above this threshold, then again he will default. But here the defaults occur they're for 2 reasons. So one is this one I would call it's a strategic reason, and here it's just it's kind of bad luck. So to me it's that if this is a situation where if Clinton and the U.S. Treasury come in and say we'll roll over your debt, he would say okay, we'll keep repaying and things are going to go on a little longer. And so that's a reasonable thing to do. So this is like a bank run. So this here, it's like a bank run, and outside intervention could be welfare improving. Up here, this is just the guy's borrowed beyond his desire to repay, and if you dump more money on him, he's not going to repay that either. So if Tim talked about this, running down your debt if you're in the crisis zone. If the economy's in recession, the question is, how'd you ever get up there anyway? You didn't want to be there. So the running down the debt is, you have to explain the initial conditions. How did you get all that debt in the first place? Okay, so let me just make a couple of more general comments. So this paper asks when and why do governments default? And I think that the useful point to me it made is that you can think about strategic default where, you know, it's a calculated risk. I'm going to run up the debt too high and default if you know, the recovery doesn't occur. And the other is this, you know, kind of bank run scenario. So we'll call that non-strategic. Now, here the motive to borrow was always consumption smoothing. But to my mind, the question of, you know, why do governments default, you know, then you have to think about, well, why did they borrow in the first place? So to me, that's kind of the main unanswered question in all this literature about sovereign debt. We can ask who they borrow from and the maturity structure of the debt. If lenders issued longer maturity debt, then crises don't occur. So, you know, we can avoid that problem. But why do governments borrow? So, you know, so Tim, you know, took a Ramsey approach. You know, I've done that myself, so I'm not going to fault him for it. But I think it's not the only reason, and maybe not even the main reason, why governments are defaulting, you know, in the post-World War II era. So, you know, another motive is just political, to spend on, you know, policies or programs that are going to keep the incumbent in office. Or, you know, Tim mentioned this, another possibility is fiscal stimulus. If there's a public perception that government spending is going to get us out of the recession, maybe that's another motive for to borrow when you're in a recession. You know, who do they borrow from? You know, I suppose if the lenders are foreign, it makes it easier to default on the lender. As I said, long maturities let you avoid the bank run problem. You might have to index the debt if you're you know, or denominate it in a stable currency. But to me, this paper raised as many questions as it answered, and mostly about the why governments borrow. And I'm not the only one who's thought, you know, to me, it's a stunning fact about, you know, the kind of recent 20 or 30 years that, you know, if you think back to an earlier era, you know, 100 years ago, even 50 years ago, governments borrowed basically in wartime, and then after the war's over, you pay it off. If you win, if you lose, you know, you don't have to pay. So, but that in the recent era, it's like everybody borrows all the time, and, you know, just for what reason? Well, yesterday in the Wall Street Journal, there was a review of a book about America's fiscal constitution. And the reviewer starts with this. I was just struck by this. What drives a great nation into debt? Judging from recent experience, just about any excuse will do. Since the turn of the century, the United States government has borrowed to fund wars, finance tax cuts, boost the economy, provide public health, pay pensions. In 2009, the largest peacetime deficit in the US history was announced, and soon after, Standard & Poor's removed the risk-free rating from US treasuries. By the end of last year, the stock of public debt exceeded GDP. So, and, you know, Europe is doing the same. Japan is, you know, it's 2 times GDP. So why all this borrowing? This is not just to smooth. This is not to smooth consumption.
In fact, there's a student working with Christina and me in Minnesota who's Finnish, and she's looked at this. You know, the return to markets, we definitely don't have it in our model. Hal and I, in one of our papers, talked about it. We could make that be stochastic, and the model keeps the same general structure. But returns to the markets is speeding up. The average amount of time that you're, like Mexico was frozen out and defaulted in 82, and it was back in by 89 in the international markets. But now countries, of course, Argentina is going to be out for a long time. But no, the average country is coming back faster and faster, which means there's more of an incentive to fall, which means the debt levels and the sustainable debt levels should go down, right? So I don't understand. I mean, right, Obsfeld and Rogoff had a, who had the paper that says if you don't have some kind of default penalties, you can't sustain debt. So this is lowering the default penalty, the faster we turn to markets. But actually, talk about liquidity crisis. This woman, Laura Sunder Plossman, she found that lots of things that are classified as default, people end up paying a haircut, ends up being zero or negative. It's kind of like you miss a payment on your credit card because you have some liquidity kind of crisis, and then 6 months later you pay back plus penalties. You pay back everything.
Yeah, if you look at the distribution of haircuts, it's bimodal. There's a lot of haircuts which are zero. Some even have negative present value haircuts. And then there's a sort of space in the middle of it. There's the defect. It's kind of that bimodal distribution.
Right.
Because for some reason, you know, like an extra penalty if you have a nominal haircut. Banks don't like it. Just to play the devil's advocate on Spain, just for fun. I mean, the IMF does claim that Spain's going to grow this year, by the way, just over 1%. And sorry, going back to the so two things on, again, just to play the devil's advocate. The Troika can come up with long-term debt, and that shifts your savings around. Or it can come up with some kind of guarantee scheme, and then say, like you said in Mexico, they didn't actually use it, but it'll reduce the interest rate on the private debt that you borrow, assuming you can control the amount of debt out there, right? And then that could also help, right?
That's completely right. That's completely right. And that's within the context of the model. The problem is, and this is, I thought Nancy's discussion was fantastic, but there are some things that are missing, and that's that upper limit is very high. That's why I don't think that, I think our model is good for some things. I don't think it's good to distinguish between liquidity and solvency, because if you impose too high of a penalty, the country just, the penalty interest rate, you just decide to default. You know, so the ECB during the summer of 2012 had this policy of buying, not they bought. They told banks, if you will buy Spanish and Italian debt, we will let you use that as collateral on loans that we will give you at shockingly low interest rates. It was saying, we're going to just subsidize you guys buying, right? And what did that do? That really, at least for a while, lowered the prices of the
But if you do that, but then you have to report to me, I mean, you would put the amount of one country and...
no,
was
things...
not used.
Oh, it wasn't used. Okay.
Just the track of, just the possibility of that.
Was lowered. But see, if you lend to the troubled country at a very low interest rate, they're happy. They're not going to want to default, but they're not going to want to cut their spending. See, that's the thing that the recent paper wanted.
This model is missing the model of the, like the fiscal response. If the ECB is just, handing out cash.
Right.
Oh,
they're doing, that's what my point about George Papandreou. If Mrs. Merkel gave him cash, he was right to spend it all, which he did. Oh, and the numbers dwarfed Clinton's bailout. The first time around, he got $100 billion, and then a year and a half later, he got $130 billion.
But Tim, you're wrong to call it a bailout. It was a loan. It was a loan.
It was a loan.
And as you said, at penalty interest rates against good collateral.
Right.
I wouldn't call that a bailout.
Oh, okay.
Greece looks much more like a straight-ahead bailout. Or just a lot of money being transferred.
The Mexicans paid that back. It was a 6-year loan. They had it all paid back in 3 years. whatever. That worked. Rhodey's.
But if it's a loan, why don't the private sector provide that? Why do we need Clinton?
So what Mrs. Rhodey said she was
But I
going
would
to
say
raise was a loan too.
they structured that loan so that they were pretty sure not to lose money when they did.
Well, there's something here which I don't think we have a good model of, which is preferred creditor status. So these guys come in and they're the ones who will get paid first, and so the country will default on the private guys. So there's not all creditors are equal, right? And I don't think that's in our models.
But it seemed like the other thing that was going on in Europe was the German and French banks held a lot of the Greek debt. So Germany and France were on the hook anyway to, recapitalize their banks. And so maybe it's a little bit more expensive if you do it by lending to Greece, and there's a little, seepage there, but you hold the Eurozone together. So it seemed like that was part of their pull.